Well, thank you, everyone, for joining. We obviously have a distinguished panel here of seasoned executives and founders of esteemed companies in the space, and so we're obviously here to talk about M&A, when to buy, when to sell. And so with this group, I guess maybe I'll be a little bit provocative here and start off with the obvious question. Some of you who may be thinking about it in respect to your own businesses, what you sold, or businesses that you may be looking to acquire. But we're obviously in a record valuation environment here. Very strong multiples. I think even headlining this conference, some pretty big prices for assets being paid. And so the first question I'd throw out to you guys is, from your perspective, do you think we're in a bubble? And if so, what are the signs, and how do you guys go about evaluating M&A in that type of a market environment? And maybe, Ron, if you don't mind, I'll start with you. Obviously, one of your headline transactions got announced, a very, very successful outcome for the shareholders. But maybe I'll start with you and get your perspective on that.
Yeah, well, I would say, given that we announced yesterday, we're absolutely not in a bubble. I think whether we're in a bubble or not is super hard to say in a very global way. I think the foundations of a company, though, will ultimately trump. And I think when you look at some of what's been paid, particularly on the higher end of valuations, a lot of those businesses had incredibly sound economic underpinnings, right? They had the growth, they had the recurring revenue, they had the total addressable market that was very big, they had hit critical mass. And so given that those foundations were rock solid, I would not necessarily call those in a bubble. On the other hand, I've seen things that have been on the come, right, that I think, at least for me personally, has raised an eyebrow because they've gotten really great multiples, but are still companies that were proving themselves out. So very hard to predict and say conclusively where the bubble lives, or if there is one.
Travis.
Yeah, I think in that fringe category of companies, you sort of see the amount of available capital. I made a joke yesterday that a dog walking down the street in San Francisco could raise $5 million. So it feels like there is a lot of available capital. So there's a lot of people making bets, I think, that in a more structured economic time might not be made. So I think that's what sort of alludes to it, but I don't feel overall the market itself feels like it's a bubble.
What, along those lines, I mean, Heather, as we look forward, what in your mind would be some indicators of kind of a bubble? So if we agree collectively that we're not in one, a lot of the valuations are high, but they're underpinned by very solid fundamentals of the businesses, what would you kind of characterize, as KPIs of being in a bubble?
It's a good question, and obviously I'm in a very different part of the market than the rest of the guys on this panel, so you really have to look at every different niche to determine, is it a bubble, is it not, and what metrics are you going to look at in each of those sort of niches. I think personally what I would say about being in a bubble is we're actually more in an echo chamber, right? So we sit in these conferences and we hear about all of these big deals that happen, and some of them make you say, wow, that's a big meatball, but at the end of the day, you look out and for every deal that you say that, you have 5 companies that didn't get funded. You have 5 companies that shut down. You get 5 companies who did a down round. So, am I looking for a bubble? No, not really. I think in this space, you have about 200 to 250 companies that get a seed round every year. A third of those get an A, and then it's half from there and half from there and half from there. So every once in a while, you see a company get a D or an E, and it feels like a big round. But it's just, if you look historically, every year you've got about the same number of companies. So if it's 5 Ds versus 2 years ago it was 2, it feels like a much bigger year than would have been otherwise.
Can I just to add? I mean, we got our start in 2013, 2014, and people then were saying, "We're in a bubble. You're too late." And I think probably every year people ask that question and continue to ask it. And I think someone said in one of the panels yesterday, Q1 was a record investment quarter for the space. On the other hand, you look at outside of just ed tech, HR tech, and we have gone through what is an above average period of economic expansion, right? And so I think just naturally if you just look at trends in history, over the next several quarters to a couple of years, we are due for a correction. Whether that means we're in a bubble now or not, I think the takeaway is the same, which is how do we plan for that?
No, that's and then along those lines, there was a point made about critical mass, and when you guys decided to pull the trigger on the M&A side, either as a seller or as a buyer, and I'm guessing for a lot of the companies that are attending the conference, they're young companies, nascent companies, growing rapidly, but still achieving scale or attempting to achieve scale. As both buyers and sellers, how do you guys think about the notion of critical mass? Are there any lines in the sand that are important to you, whether it be users, whether it be, and I know you all operate across different spectra here of businesses, but in terms of revenue, in terms of users, how do you guys think about critical mass in terms of when it's time to buy or sell?
I can start. Obviously, the term critical mass is a relative term, right? So when we look at companies specifically at Chegg, number one thing is, are they helping students? And if they're part of our platform, can we help more students with their technology, with their people? Obviously, it has to fit with our strategy. And if we're doing that, then that checks a big box. So there's no hard magic number that I can say, if you're not for of something, we're not going to look at the deal. But is it going to accelerate our growth? Is it bringing a team or a technology to our platform that we didn't have already? But if you're really asking the question from the perspective of a founder who's putting a page in their VC deck that says, hey, we've reached critical mass, and they don't want to get laughed out of the room when they say that metric, what is that, right? So I think you have to look at it again from a relative perspective and say, if I'm speaking to an investor that's got a whole portfolio of companies that have 2,000 schools, and you come in and you say, I've reached critical mass because I've got 100 schools, they're going to laugh at you, right? So who is your audience? Who are you selling to? And what are you trying to accomplish with, whatever it is that critical mass term is trying to solve for you?
Yeah, I think, when we look at certain segments, so the number one set of phone calls I get is company A just sold for value X. So obviously B, C, D, and E, those companies are also worth that, which is really interesting. They always are. They hire good bankers to help them do that equation. But I think one of the big things that we look at is scarcity. And I think really aligned strategy is foremost. But as we look at certain segments that are interesting to us, like how scarce are the good resources in that space? There's always lots of resources, and that's why we all have teams that go out and analyze what are the good ones in those spaces. But I think that's where we're seeing a lot of drive for things that move up our strategic priorities. We're a big company. We're a $7 billion valuation company, and so if we look at, we always have competing priorities across the whole suite of products, and so how do we move things up and down that priority list? We have that conversation a lot, and a lot of it is driven by needs on our side, how it aligns with strategy, and then as well scarcity of options in those spaces.
And maybe Oliver and Ron, for you guys, in terms of critical mass as a either founder or seller, and as you guys embarked kind of down your journey in terms of how big of a business you wanted to build, were there any kind of critical lines in the sand that you guys had in terms of how you assess critical mass for your own businesses?
Yeah, the way that we were thinking about this was a company I founded, Teacher Match. The way we thought about it at that point, we were a SaaS platform with recurring revenue. Is critical mass for us was getting over $1 million a month of recurring revenue. So it was a $12 million kind of watermark. And I think one of the truisms that I've found in that part of the market is the bigger you are, the more you're worth, right? Because you're more competitive, you've got more critical mass, you bring in a much bigger pool of buyers who become interested. And so one of the pieces of advice I give to entrepreneurs is if you can hold out to get to that critical mass, whatever that looks like, the bigger you are, the more interesting you are. And no one wants to really put numbers on it, but I think, if to swag it, $1 million, if you get over $1 million, you're kind of interesting on an annualized basis. Over 10 million starts to feel like, depending on how big your addressable market is for whatever it is you're providing, then getting over 10 million is kind of that next hump where I think it gets people really excited and interested. So no magic numbers, because all of the nuance mentioned matters a lot. But I think without some of those numbers, it's very hard to get a certain level of investor really to lean in on the acquisition.
That's super helpful. Oliver, your thoughts?
Critical mass is sort of a moving target, right? When you asked the question, I immediately went back to kind of the early days, and I was like, critical mass for us was first customer, right? And then it's 10 customers, and kind of the Jason Lemkin, SaaS approach, which is just keep multiplying that, and if you can get 10, then you can get 100. If you can get 100, then you go after 1,000. So I think that we definitely had kind of those numbers and everything that as founders we were focused on, but at a team level, critical mass was always this set of goalposts that you move, focusing on, does this in fact demonstrate capability to go to that next stage? So I do think as a founder, that's a little bit of a moving target. And then even within those, you can break those down, and there's critical mass within an industry vertical, right? So you talked about kind of the number of schools. There's a number of ways to kind of get to critical mass. I think building a good, solid business comes down to, do you have a good product? Do your customers love you? And is there some repeatability to the model? And if you have those ingredients, then I think you can get to a whole bunch of critical mass milestones.
And I think you touched on a great point that critical mass is a little bit in the eye of the beholder. Obviously, Heather and Travis, operating multi-billion-dollar companies. When you're looking to acquire companies, I'm sure part of the discussion is, does this move the needle for us or not?
Right.
That's probably the $64,000 question that you're always evaluating. In the context of moving the needle, how do you guys think about critical mass for assets you want to buy?
So one thing I see a lot of is companies that don't necessarily understand what would be of value to a company like us. I was looking at one last week that they have a great partnership that they've built in China, and the ecosystem they built in Southeast Asia is really strong. It's like our business is predominantly in North America. That has zero value to me, right? So trying to align knowing your audience, I suppose, a little bit to some extent is very important to us. That we're very impressed with founders and young companies that come to us. The best conversations we have are typically somebody who's not necessarily looking to sell their company at the time, but they understand sort of what would be of value to us. A lot of times it starts as a partnership conversation, because that's when people actually come to us and say, hey, we'd really like to partner with Ultimate. We understand you do this, we do Y. How do we make these fit together? And a lot of times those are the ones that bleed into more of an M&A conversation, because they sort of got why we were in the room together, not we're looking to sell and here's the assets we have. So.
Yeah, if you're going to push us to say a number, which is what I think what you're doing, of course there are numbers of what's going to move the needle. When we've got hundreds of millions of dollars in revenue, picking up something that's got 2 is not going to move the needle from that perspective. Of course, when we look at companies that do come to us and have revenue and have EBITDA or EBITDA potential, we want them to grow at least 40%, or at least be able to grow 40% on our platform, because we've got numbers we have to hit as well. We want them to be able to hit at least a 25% EBITDA margin for the same reasons. But that doesn't have to be day one. It has to be once we integrate it into our platform, is it going to grow that way, and is it going to generate those margins? But from, does it move the needle? For us to go out and buy something in this market that moves the needle from a revenue standpoint, it's really tough, because there's not a lot of businesses that are built around B2C models, which is what we are exclusively. I know that's different for you guys, but it's looking at, in some cases, B2B models and saying, does this translate to the B2C market, and does it move the needle? Or further to that, it's really, is it moving the needle for the students? So going back to what I said before, is this a tool that's going to help, I won't get on the soapbox of all of the problems in the education industry, because you've heard lots of that already. That's not what this panel is about, but for the 60% of kids who get to school and don't have the math skills to get through their first class, or the writing schools to even graduate, are we moving the needle for them?
Got it. Switching gears, that's a very helpful kind of perspective from the buy side. I think Ron and Oliver, as sellers of businesses, as entrepreneurs, as founders, a lot of this in terms of the context of M&A and when to sell, a lot of it is partly logic, but also partly emotion. And for your own sort of internal drivers to decide when to sell, obviously valuation's a key factor, but it's not the only factor. I think it'd be helpful to just get an understanding in terms of what were the other additional internal drivers from kind of either a business, personal, emotional perspective that you guys evaluated as you thought about, now it's time to sell?
I mean, I can talk about us. We never built a business to sell it. It sort of just happened. But we were acutely aware throughout the process that if we were going to sell, we didn't want to have to sell, right? And so not being in that position where you've got to sell, but it's one path of many you could take at that point in time. And for us, we looked at the market, the environment, and there was a couple of different paths forward, right? You can continue to go raise that next round, all in service of distribution, right? So we wanted distribution. We wanted a platform through which that we'd either build ourselves, sales and marketing, or with an organization who had that in place where we could really get our product in as many hands as possible, as quickly as possible. And we decided to, entertain the notion of what other platforms out there would help us get to what we at the time were thinking is critical mass. And so that kind of started us down the path of, well, maybe selling is an option. And then when we went down that path, there were several things. We had discussions with a lot of folks. Initially, it was partnerships, as you said, and we were just looking to understand what the market would bear and what the market was interested in. What our value was to each potential long-term partner. And then the three things kind of as founders we were solving for were, how's the team going to get taken care of, right? We'd spent a lot of time investing in what we thought were good people. What's going to happen to customers? And then ultimately, what's going to happen to the product over time? Now maybe that's a very naive view of looking at it. Valuation was the fourth, right after those top three. But we wanted to put ourselves in a position where they checked all those boxes, and then it was anybody who made it that far. Then it was a question of what is valuation going to look like in terms of our investors, in terms of employee outcomes, and so forth.
Yeah, I think it's not terribly dissimilar. I'd say there was kind of four lenses that we kind of created an internal rubric, the team, to think about it. One is people. Did we like the buyer? And it actually mattered a lot. And were they investing in the relationship kind of before the sale? I think good buyers spend a lot of time doing it. So one was people. Two was economics, kind of what was the best economic package and outcome. And part of that was risk. So I think part of the question of when is kind of when do the numbers look best? So if you've had 3 great quarters, right, and you think you can transact quickly and you're risk averse, that might be a particularly great time to do it. And so part of the economic package is whether you want to take the risk of betting on your own growth or if you're having some good numbers, taking advantage of that. The third is what I call the morning after, right? And I think this is the most important one. As an entrepreneur, I loved what I did. My team loved what we did. Most entrepreneurs I meet, as difficult as it is, love what they do. And I always ask them, what's it going to be like the morning after? So now you've sold your company. If you've sold to a large strategic, you're going to have a very different title. Your world will change. People say, well, it won't really change, but it dramatically usually does change in that case. And what is it that you want to be doing? What's the legacy of the company, right? What's kind of, how do you feel after you've sold the company? And so I think those are kind of some of the variables to think through as someone who's selling a company.
And going back to you, Travis and Heather, for a second, obviously we started off the discussion of, are we in a bubble? Our valuations getting too rich in the sector, and this is kind of across the human capital spectrum, so not specific even to just ed tech. It goes into HCM and the whole spectrum. But at least from what we're seeing on the M&A side of it, a lot of M&A is not all just about offense right now. Some of it's also about defense. And for the assets you guys are looking at, when do you guys decide if something is sort of a must own? That, look, I don't like paying the price, but if I don't pay the price, it could mean the demise of my own business. How do you guys think about that? Have you come across situations like that? Maybe not even recently, but even historically. And how you guys have you thought about that?
It's a great question. We spend a lot of time my team's in the front, they spend a lot of time doing the work around what is the long-term strategy, right? So not just what do we need to look like in the next 2 years, but what is the next 5 years and what is the next 10 years? And what do we want education to look like, and what is our role in driving that? And so we've got a whole roadmap of how do we fill in the holes that we need to get. It's a puzzle of how are we going to get from where we are today to where we want to be and where we want the education system to go. So there are categories that we know we need to be in at some point. There are technologies that we know we want to have at some point or develop. You probably know Chegg does a lot of acquisitions. This is why I'm on the panel. So a lot of times we look externally for what are we going to fill those holes with and what companies are out there. We've not been in a situation where we felt like we had to buy a particular company because there wasn't another one out there that was suitable. It's sort of the Netflix model where you don't have to have the best superhero show. You can put a lot of money into Adam Sandler for some reason and still get laughs. But we look at different categories, and once we find an asset that fits those categories, and much to what these guys were talking about before, some of the best deals that we've done have been companies that we've known for 5, 6, 7 years, and we've stayed in touch with, and we've seen them grow, and we've maintained a friendship and a relationship, and we've seen that the culture fits with our company, and that they've executed on all of the things that they said they were going to do. And in those cases, we feel like we need to own those businesses. But at the same time, we also have developed a relationship where those founders aren't saying, I'm going to squeeze you for a number, because they're so excited to come onto the platform and build something really big together. So in a lot of cases, if you're a founder and you're thinking about selling, there's going to be some earn out or some piece where the acquiring company wants to incent you to stick around. And if you're not passionate about going to that company and sticking around and making it successful, it's not going to be good for either side. So, to answer your question briefly, no, we haven't been in a situation where we've felt like we need to pay up for something, because there are a lot of options out there in the categories that we look at, and it's really about finding the right teams and the right people to make that work within our ecosystem.
Yeah, I think that's a great point. I think the one thing that's really interesting for us, and particularly in my team's job, is Ultimate Software does not have employment contracts in terms of non-solicit, non-competes, things like that. So if you want, basically our attitude is if you don't want to work at Ultimate, you're free to go, but you can't come back. Like that's sort of the general thesis is you got to want to be here and buy into what we do in our culture. And if you look at sort of best workplaces and things like that, we invest very heavily in our people. So from a corporate development standpoint, it's really interesting for us to make sure we get the people aspect of every deal very, very correct. Even when we're initially sort of shopping deals internally to teams, the first question is not usually about the IP or their business they have. It's about who are the people, what's their background, why do you think they would be a great fit to be part of what we're doing, right? So for us, that's been a disqualifier on some really great IP and some really great opportunities, because we just didn't like the people that much and didn't see them being here 5 years later and helping us do this thing together. And I think in our space it's important because there's a lot of big companies that around the HCM space. If we look at our competitors, lots of very well-funded or other public companies. So it's really important to us that we get the people aspect of all these deals right. So sort of goes back to that scarcity item we were talking about earlier too, right? It's not just the scarcity of the IP that's there, but it's also just how good of team can we find, and how much are they going to fit in and be part of what we're doing and really buy into the Ultimate culture.
Got it. Thank you. Switching gears, and this is kind of a question for all four of you. And we run into this sometimes on the advisory side, where we have lots of great companies and great entrepreneurs, and they've sort of been below the radar for a long time, and then all of a sudden they pick their heads up, call us, and say, "I'm ready to sell. Go get me paid." And we're like, well, it's not exactly that simple. I think in this sector, our mantra has increasingly become that great companies are bought, not sold. So even in sale processes that we run, many times the buyers are ones that have tracked the asset for a long time, have established a dialogue with the management teams or the sellers, and are able to demonstrate that they can kind of move that much faster than the market. So the velocity of M&A is almost as important as the valuation, because it's all about risk at the end of the day. So as kind of both buyers and sellers, how do you guys think about the cycle of M&A, the sales cycle, if you will, for M&A, in terms of kind of the T- sale period when you decided, okay, you know what, I don't know exactly when I'm going to sell. It's a little bit different for Heather and Travis, I get, but for Ron and Oliver's, for you guys, I know you didn't have an exact blueprint of when you wanted to sell, but maybe had a little bit of an idea of, in the medium term, here's where we may go. How much longer before that did you guys start kind of engaging with potential acquirers? What was kind of the nature, the talk track? How did you sort of reel them in, if you will?
Yeah, I can say in the teacher match world, and we were both, because bought 3 companies that we rolled up, and then we ended up selling it to Vista, is I think sometimes entrepreneurs get the sense that, I shouldn't be talking to folks because I'm not for sale. I would give the opposite advice, in the sense that there'll be investors and companies that are tracking, and conversations are great because you'll always learn something, right? You'll always get great feedback. You'll get to know who a theoretical buyer is. But in essence, you should always be for sale, in the sense that you may absolutely not sell at any point, but investing in the time and energy to get to know the buyer universe. So when they call and say, hey, can I stop by? At least our policy was, we'd love to have you stop by, and we'd spend an hour or 2 with them, give them a high-level overview of the business. We wouldn't provide detailed financials, mostly because if we missed our numbers, we wouldn't want anyone to know that we'd missed our numbers, right? So we wouldn't give any numbers, but we'd paint an overview of the company, what our vision was, what the passion was, where we were going. And we let them know that, at some point we're probably likely to transact in the future, with the belief that you get people really excited. And much like just the human factor of all of it is that when people come and they spend time with you and you spend time with them, it builds that level of comfort, so that when you actually enter the process, you have a pretty good sense of who's going to show up. You're going to have a sense of who's going to lean in most. And there's kind of a sunk cost dynamic to it that I think about, which is if someone has come and visited you 2-3 times, they've now gone back to their investment committee and been really excited. Hey, there's this great company. I think it's really interesting. I've spent time with the CEO. They're really vested now to want to lean in on an acquisition. And that might mean an extra half turn or a full turn on the multiple if they've really been at this for a while, because they're now really vested, versus an auction process where there's no relationship. They're coming in, they're going to tell themselves, well, I might add a little increment to the economics hoping that I can win the company. But they're, I think, generally less inclined to do so because they haven't invested the time and energy for the relationship, where they're like, hey, I know this management team, I know the vision, I know what's going on in the company. They're much more motivated to invest more.
It's, sorry.
No, good. I was just going to add quick. We're often accused of being very slow because we're big, and all strategics are very. If you're willing on your timeline and you're dealing with strategics, like double it, because that's what it takes us sometimes. But that is one thing that really helps accelerate the velocity of a deal, is if we know the parties, and we're not getting it from a banker for the first time, even if it might be something interesting that takes us so long to get the wheels spinning. Like, we're good once we get going, but just to your point about, if you know the parties, it usually goes a lot faster. Sorry.
Well, I was going to say, you mentioned the word relationships. I think investing in relationships never hurts, right? Whether it comes down to M&A and kind of a sales outcome, whether it's a customer relationship, whether it's just good karma for down the line. Looking back, amongst the folks we got, close with in the process, or close to doing something with in the process, a customer was included in that. So we had developed a long-term relationship as a service provider for that organization. We had folks who were involved pre-company in terms of just being personal mentors or insightful industry experts as we were thinking about kind of the space, that ended up being in a position to potentially be an acquirer. And then there was all the folks we had to kind of meet relatively quickly in comparison, but it still took several quarters of getting to know folks. So I think exactly as you said, it's not, companies aren't sold in the space they're bought. And in order to put yourself in that position and at least have those opportunities, I do think you need to be, talking to folks. Now, it's a really fine line, and at one point we almost crossed it, where you actually can be diverted away from building your own business if you get sucked into those conversations earlier than you'd ultimately like to. But if you can continue to build your business and focus on it while entertaining kind of those conversations and building those relationships, I think it works. And size doesn't matter. The company that ultimately acquired us, they were the merger of two companies where a larger organization tried to buy a company that was a fifth of their size. That company, again, was not for sale, had no interest in selling, but turned it around and bought the bigger company. And then that company then was PE backed, and then they kind of rolled us up and is growing pretty quickly. But you never know kind of what's going to happen in this space, right? It's pretty fluid. You just got to focus on building a good asset.
I mean, it's really no surprise that you should spend time developing relationships with people in the space, particularly people that might buy you one day. There's not a lot of companies, although we're starting to see more, there's not a lot of companies, at least in the space that I operate in, that get public, right? And so you have to get to an exit at some point. And it doesn't mean you need to be planning to sell all the time. It means that you should think about when is the right time for you as a founder to sell. If you're a technical founder and dealing with accountants and P&Ls all the time isn't very interesting to you, and you want to get back to the thing that you're excited about, that's a good time to think about selling. If we've talked to companies that told us no for 5 years, and then suddenly they have a baby and want to buy a house, and that changes how they think about it. So this is a relationship business as much as it feels like it's about math and numbers and multiples. It's the same reason why you don't hire someone to go figure out who you're going to marry. You have to live with that person every day and have that relationship and spend a lot of time with them. So you want to make sure that you're spending the time with people who are those good relationships. And even if somebody's got the biggest multiple, if they're a bad word that I want to say, you don't want to go to those companies.
I think one of the most important decisions to think about early on is kind of this morning after questions, what do you want to do when you sell your company, right? And there's an opportunity to sell your company to a financial buyer, right? And you wake up the next day and you've traded out your ownership and you've got a different equity package, but fundamentally life doesn't really necessarily have to change that much, right? Or you can say, hey, I want to sell to a strategic, right? At which point I think you have to have the expectation that life will change pretty dramatically in terms of how you're running a company, and kind of understanding those two dynamics in those two worlds. And by the way, they both can be really great. We sold to Vista Equity and were merged into People Admin, so it was a strategic sale, and it was fabulous for us. It was very much what we needed, and it worked out incredibly well for us. And so I think they both have plus and minuses, but it's a really important key decision, right? Because if what you love as an entrepreneur is running your own show, being kind of in control of your future, then a financial buyer might make more sense, and that might be where you want to spend more relationships. The only caveat I have to that is, given the consolidation in the M&A market in education, I think it's going to be harder to survive as a lone point solution in this world. Because with critical mass of scale, not critical mass of selling or buying, where companies, for example, in our space, in the K-12 area have so many products into school systems on the technology front, to just try to come in and add that 14th solution is going to be harder and harder in this world of consolidation. And so lots of factors which I actually think will make it harder for brand new companies to succeed than even 5 years ago when I found a teacher match.
Now that brings up kind of a very interesting and what I'd say final kind of question, so parting for parting words from the panel is talking about the future of M&A and sort of how consolidation will work in the future. I guess kind of two quick questions along those lines. Number one, from your perspectives, and Travis, I'll maybe start with you and come down the line of if you had to point to one or two spaces in which you'd see kind of the most consolidation happening just as a category, and how you see kind of the velocity of M&A in that category evolving, what would those be?
Yeah, it's interesting. So we are very focused as a business and have been, Ultimate's been around for 28 years, so we've been very focused on the HR buyer. So we sell a full suite of HCM solutions. And so for us, that consolidation has gradually been happening over time. Like our business started as a payroll business 28 years ago, right? And now we sell everything from learning all the way down through, automated tax outsourcing and things like that for companies. So it's a really interesting spectrum for us as we look to add categories to what we do today. It's what else is the VP of HR or the CHRO looking to buy? And for us, that's been the suite, over time that's grown to. But we are seeing from a competitive standpoint, financials and ERP and those sort of things bleeding into what we do. So, I think as we look at, consolidation for us is a lot about where that line is going to be drawn. I think there's always a continuum, but the line has broadened over time that, 10 years ago, you might not have bought your talent management suite from your payroll vendor. But that's something that's consolidated and sort of bred off of the Oracles and the SAPs of the world, not necessarily doing a great job at providing rich functionality there. So I think there's always going to be that line of consolidation where it happens. From a space standpoint, so we look at when we think about learning, it's LMS. Is really for a lot of our customers or how people would think about it. That's a very fragmented space today. If you look at the money that's been put in that space and the number of companies that go to market looking to be sold or be bought, depending on how you phrase it, there's going to be a lot of consolidation there. And obviously even the bigger players in that space have had their ups and downs throughout the last few years. So, I think the LMS space will contract a lot and some of the things that go around it. But then I think the greater HCM space is all about defining where those lines are going to start and stop.
Sure. It's hard to look at sort of the categories that we see in the consumer ed tech side and not imagine that almost every one of those verticals are going to consolidate over time. Obviously, we're already seeing skills-based learning companies and MOOCs and those types of categories consolidating or shutting down. It's an idea that makes a lot of sense and has its place in the market, but there's so many companies trying to do that same thing, and some of them have done better and some of them have not, but it's figuring out how do you build an audience and scale and get to your point, a critical mass where you actually matter in the industry and you're solving that problem. I think we're still early days on that. Similarly, admissions businesses, there seems to be a new one of those every couple of days. Some of them doing really interesting things. Some of them have more schools than others. Some of them have more students than others. So figuring out how do you put those together to make a real compelling product. Similarly, if you're selling into a school, how do you leverage that sales force to be more productive? So are there more things you can put into the toolkit that help you in that same vein? But generally speaking, the great thing about a conference like this and the great thing about the EdTech space is there are so many people who are passionate about changing the world and changing the dynamics of the education industry that there are new companies all of the time. And so some of them will get funded, some of them won't. Doesn't necessarily mean they're bad companies or bad ideas, just means they may not be at the right time. They may not have found the right partner. They may have not been able to find patient capital to build an audience. So those companies are going to have to think about who's the ultimate buyer of this idea if I don't want it to die.
I think, there's a couple of different forces at play here. So if I look at the HR tech landscape, there's new products popping up every day, some of them doing interesting new things, but in pretty much almost every category there is way more companies trying to go after that market segment than there is opportunity for any one or handful of them to get really big. So naturally there will have to be consolidation for some of them to get big. I think the other thing going on is there's a late stage, as much as there's record investment going into the space, I think later stage investment, there's a little bit of a crunch for some of these companies. And so I think naturally they will have to find an exit. And one of those exits, will be a sale and consolidating into a larger player. And what's interesting is I think there's going to be consolidation, but it may lead to, interestingly enough, some fragmentation at the biggest levels, right? We're talking about this year, Google, Facebook, potentially Amazon being in, this HR technology space, and these are companies that are big and definitely, can acquire a whole bunch of really interesting technologies, have a distribution platform, have relationships, and I think really have a shot at staking out some sizable ground here. So that might create, as a buyer, I'm excited about that because there's a little bit more fragmentation amongst some of the bigger players in terms of who I can go buy a complete suite of solutions from. But I do think that will consolidate a lot of the smaller stuff.
I'm a big believer that we're in for ever-growing massive consolidation, and we're going to end up with a few, particularly as it goes to direct sales to school districts. Let me talk about that world. I think we're going to end up with probably 2 big players, and that it will be very hard for small players to compete. And the reason I have conviction around this is because when you look at the complexity of data for school districts, they need to understand student growth data. They need to understand their adult data. They need to understand what is the impact of teachers on students. And it grows from there, right? And good tech solutions help do that. Well, as the consolidation happens, you get single platforms that can manage and own all of this data. And that simplicity is wildly compelling to school districts. And for anyone who's sold into school districts, you're always going to hear 2 things when you're selling in. One is, and I remember when I was superintendent in Chicago, I would say the same thing, which is I can't ask my principals to go do one more thing, right? So one more great piece of technology that sits out here that will actually be more of a burden than a value add because it's just something outside of the ecosystem is a very hard thing to overcome in a sale to a school district. The second is integration and how the data flows. And to the degree that you own the data, right, you'll get to own that relationship. And then you can be benevolent about it, right, and let people integrate and plug in. You cannot be benevolent. You can own that universe. But I think the idea that that it won't consolidate is just not the reality. If I teacher match 5 years ago, when we were selling 2 different things, but part of it was we had an ATS solution that went with our pre-employment assessment system. And there were 5 players in the marketplace who were selling applicant tracking as an example direct to districts, right? Today there are 2 of them, right? Now that's not, 5 to 2 is not massive, but those 2 now sell it as part of a much, much broader suite, right? And if someone created, if I use that as an example, the world's greatest ATS, right? You'd almost 0 chance of getting into this marketplace at this point because someone's bought a whole suite of products and it won't be able to stand alone. And so I think that speaks to the fact that this is just going to continue to go to a few big players who own that data.
Well, I think just have a couple minutes left, but I think want to thank the panel. Appreciate all the thoughts and perspectives, and thank you again. Appreciate everybody attending.
Thanks, Ron.